Hey guys, welcome back to the channel. Today we'll dive into the world of convertible loan agreements, an exciting tool used by many companies, investors and shareholders. Whether you're a startup founder, a seasoned investor or just curious about how companies raise funds, this video is for you. So what exactly is a convertible loan agreement? Simply put, it's a loan agreement that gives the lender the option to convert the loan into shares in the company at a later stage, rather than receiving the repayment in cash. Think of it as a hybrid between a loan and equity investment. Let's break down how it works. A company looking to raise funds may offer a convertible loan to an investor. In this arrangement, the company borrows money, and in return, the investor gets the right to convert that loan into shares of the company, typically at a discount or a pre-agreed valuation. This conversion usually happens during the maturity date for repayment of the loan, or the next funding round, or when a predefined trigger event such as a liquidity event or company valuation milestone occurs. And what if the loan doesn't convert? The investor will still have the right to claim the loan repayment amount with interest. Now let's talk about the benefits for all parties involved: the company, the investor, and even the shareholders. For companies, particularly startups, convertible loans can be a lifeline. Here's why. Number one, it gives quick access to funds. A convertible loan agreement allows companies to raise money quickly without needing to agree on a company valuation at an early stage. This is a huge advantage for startups that may not have an established valuation yet. Number two, it delays dilution. By taking on a loan instead of immediate equity investment, the company can delay share dilution until a future date when its value is more clear. Number three, flexible terms. The terms in a convertible loan agreement are often flexible and can be customized to suit both parties, providing more control over funding timelines. For investors, convertible loans offer attractive advantages. Number one, potential equity upside. If the company does well, the investor can convert their loan into shares of the company, usually at a discount to the market value, giving them a greater shareholding for the initial investment. There's also downside protection because in case the company doesn't perform well, the investor is protected by the loan terms. They can still get their money back with interest if the loan is not converted into shares. Number three, it defers risky valuations. Convertible loans defer the need for risky early-stage valuations, allowing investors to enter before the company's value is fully determined. Of course, convertible loans aren't without their downsides. Let's look at the potential disadvantages for all parties. For companies, the risks include: number one, dilution risk. Once the loan is converted, the existing shareholders may face significant dilution, especially if the loan converts into a large proportion of the company's equity. Number two, higher costs. Convertible loans often come with interest or discounted share prices, which could mean that the company is paying a premium for capital. Number three, uncertain future obligations. The company might find itself in a tough spot if it needs to issue shares during a down round, or if the valuation upon conversion doesn't align with the expectations. From an investor's perspective, here are a few drawbacks. Number one, risk of no conversion. If the company doesn't perform well and there's no opportunity to convert the loan, the investor may be left with just a loan repayment, missing out on potential equity gains. Even worse, if the company is in financial difficulties or close to insolvency, he may not get any payment or only part of the loan repayment. Number two, illiquidity. Another disadvantage is that investors may face illiquidity if they hold shares after the conversion, as shares in startups or early stage companies are not listed and therefore not easy to sell. For existing shareholders, when a convertible loan is triggered, new shares are issued, diluting the ownership stakes of existing shareholders, and in some cases, if a large portion of equity is converted, the investor could gain significant control, affecting decision-making within the company. To sum it up, convertible loan agreements are a powerful tool for both companies and investors, offering flexibility, quick capital, and potential upside. However, like all financial tools, they come with their own risks and challenges. It's always essential to have clear terms and consider the implications for all parties involved. Thank you for watching. If you found this video helpful, Don't forget to like, share, and subscribe to our channel for more legal insights. See you in the next video.